Good morning. Today we're going to cover cash balances. It's just the first part of the chapter, just the part that covers cash. We're not going to cover financial instruments. It won't hurt you to read them, but we are not going to cover them. Significant classes of transactions that we've covered in this class, basically just two: credit sales and cash receipts. The book talks about an impressed account. It should be in your vocabulary. You should be kind of familiar with it. They're a control mechanism. They're accounts that have a zero balance at all times. The payroll is typically an impressed account. So Miller Motor Company calculates its payroll as $543,273.36. And as they're running their payroll checks, they deposit exactly 543 blah, blah, blah into their payroll account. So the payroll account always has a zero balance because most people cash their payroll checks almost immediately. There's very few outstanding checks to reconcile. Another word you should be familiar with is cash equivalents. Savings accounts, certificates of deposit, money markets are typically cash equivalents. And it's a cash equivalent if it has an original maturity date of less than 90 days. That means it matures within 90 days of when the company makes the investment. So it's not necessarily the maturity date on the certificate, but from when the company makes the investment, if it matures in 90 days, then it's a cash equivalent. Nobody reports cash on the balance sheet anymore. Everybody reports cash and cash equivalents. The reason for the 90 days is that if it matures in 90 days, there's very little interest rate risk. So if we take a 30-year security, there's tremendous change in the valuation of that security if the interest rates go up or down. If the maturity date's 90 days, there's very little change in the valuation. Components of internal control. Thought we were done with that, didn't you? No, it's going to haunt us all the way through. Specifically here, we're worried about control activities. And in the control activities, we're worried about segregation of duties. If we go back, authorization of transaction must be separate from custody of the related asset. Custody of the related asset must be separate from the accounting or record keeping. The accounting and record keeping responsibility needs to be separate from operational responsibilities, and IT needs to be separate from all user departments. Partial credit answers, authorization of transactions must be separate from custody of assets, must be separate from the accounting or record keeping. Also keep reconciliation separate. If we look at cash, we need to make sure the bank reconciliation is done by somebody who does not handle cash receipts, does not record cash receipts, does not approve check requests, write checks, or record cash disbursements. We talked about pre-numbered documents earlier and what a powerful control they are. By now, I hope you know that I expect you to know 500 inside and out. Bank cutoff statement. A bank cutoff statement is just a bank statement for a shorter period of time. Rather than waiting till January 31st for the bank statement, we're going to get a cutoff statement. We're going to have the client has to request. The auditor can't request this because this is confidential information. So the client's going to request a cutoff statement as of January 9th. I just made that up. It's usually 7 to 10 days after year end. They want it sent directly to the auditor, and then it's external evidence, which has is more persuasive than if it goes through the client. Okay. Next, we have the bank confirmation. Again, this is confidential information, so the client must request it. Again, the client's going to request to have the bank confirmation sent directly to the auditor, so it is external information. Bank confirmation, we want to look at it. You will see in this confirmation is for the client's name is Clausen Industries. They bank with First National Bank. Part 1 is the general information about the balances in the accounts. I'm not really that worried about that. I'm going to have those on the bank cutoff statement, but I'm worried about Part 2, the loans. Most companies are going to bank with the same company that at the same bank where they have their checking and savings. They'll also get loans there. Now, Miller Motor Company likely has got relationships with more than one bank, but this Miller Motor Company, if they have savings and checking at a bank, those are the banks they will tend to go to for loans. This is where we begin our search for unrecorded liabilities. This Part 2 here, the loans, we want to make sure the client has told us about all the loans that they have liabilities. So the client tells us they've got 2 loans outstanding. Whoop, here the bank reports that they have 3. The bank has incentive to tell us. The bank wants to make sure that the client acknowledges all their liabilities. So the bank has incentive to help us here. You'll see on the left where the client signs this requesting the information, and the client requests that it be sent directly in the lower right hand corner, that it be sent directly to their auditor. Fraud is intentional. Knowingly making a misrepresentation that they believe will induce someone to act, and that person will likely suffer a loss or damage. Our 2 classes of transactions again, and here they are. The green represent our credit sales, the red represent our cash receipts. Now notice sales. If we want to audit sales, we have to look at transactions for the entire 12-month period. Similarly, cash receipts are for this entire 12-month period. Balances, on the other hand, if we take accounts receivable or inventory, accounts receivable is basically the last 30 or 45 days worth of credit sales. So it's usually much easier to audit a balance than transactions. Now, cash, yes, cash is a balance, but we're going to break cash into 2 pieces, cash receipts and cash disbursements. Although cash is a balance, cash receipts are transactions. Fortunately for us, it's fairly easy to audit cash receipts and cash, because every month we get a statement from the bank, an external party, that tells us how much cash we have, what the cash receipts were for the month, what the cash disbursements were for the month. We talked about a proof of cash earlier, and a proof of cash, as we talked about earlier, I take my beginning balance plus my deposits for the period minus my withdrawals should give me my ending balance. Similarly, for the general ledger, my beginning balance plus the cash receipts for the year minus the checks for the year gives me the ending balance. This will allow me to reconcile deposits per the bank per cash receipts per the book. So this gives me external evidence that cash receipts are not overstated. If I look at the 2627, the 1231 of the year under audit, there are 26,270 deposits in transit. The bank won't know about those until January of next year. So in the reconciling column, I have to add 2627. Similarly, last year, the client had $21,321 in deposits in transit. The bank received those in January, even though those were receipts from the prior year. So we have to subtract those out. This will allow me to reconcile cash receipts per the books with deposits per the bank statements. And if I do that in a simplest sense for small or medium-sized client, I can reconcile, that's not the right word, what maximum sales could be by taking ending accounts receivable plus cash receipts minus beginning accounts receivable. Tomorrow, we're going to cover intracompany transfers.